If you miss one line on your 2026 tax paperwork, the government can take $10,000 from you per year without ever accusing you of tax fraud in the way most people imagine it. No handcuffs, no dramatic courtroom, just a letter, a penalty assessment, and a deadline. And if you're a senior living on fixed income or an immigrant with money, family, or accounts abroad, you are exactly the kind of person this system accidentally crushes, because you're the most likely to be compliant in spirit but non-compliant on paper. That is the trap. The U.S. tax system is not designed to care about your intentions. It cares about your forms. And 2026 is shaping up to be a year where the margin for error shrinks even further because inflation adjustments, stricter automated matching, and international information sharing are turning small mistakes into expensive events. You're watching Immigration News Desk. And today we're going to do a deep dive expose of the 2026 IRS changes and enforcement priorities that will hit seniors and immigrants the hardest. Standard deduction shifts, bracket inflation adjustments, Social Security taxation thresholds that haven't moved in decades, required minimum distributions that can trigger brutal penalties, and the Foreign Account Reporting Regime, FBAR and Form 8938, that quietly destroys people who never thought they were international. Stay to the end because there's a devastating mistake that keeps repeating every tax season. People learn about these rules after they file, and then they fix it the wrong way. That one wrong move can turn a manageable compliance correction into an audit magnet. I'll show you the safer path, what to document, and when you should stop guessing and get professional help. Now let's strip away the hype and talk about why 2026 feels different. The IRS updates numbers every year. Sometimes it's small, brackets shift, deductions move, mileage rates change. But in years where inflation has been elevated and where the agency has invested in better data matching, you don't just get new numbers, you get new consequences. Your income doesn't need to rise for you to be squeezed. Your compliance doesn't need to be bad for you to be flagged. Your only requirement is to be human in a system that expects machine-level precision. And seniors and immigrants are uniquely exposed because both groups live in complex financial reality. Seniors live off layers: Social Security, pensions, IRA withdrawals, maybe a small side business, maybe investment income. Immigrants often live across borders: a retirement account back home, a family account you help manage, inherited property, foreign pensions, remittances, dual income streams. The U.S. tax system can handle complexity, but it charges you for it, and it punishes you if you don't report it cleanly. So let's start with the part that sounds good, because the government loves to sell the good part loudly while burying the traps in fine print: the standard deduction increase. The standard deduction is the baseline amount of income the IRS allows you to deduct before calculating federal income tax. Higher standard deduction usually means less taxable income, which can mean less tax. For 2026, the figures you're seeing discussed include standard deductions around $15,900 for single filers, $31,800 for married filing jointly, and $23,900 for head of household. If you're thinking, great, that means I'm safe, hold that thought. This is where the first open loop begins. Standard deduction increases help, but they can also lull you into complacency, especially if you're a senior with taxable Social Security or an immigrant with reportable foreign assets. Because deductions reduce taxable income, they do not erase reporting obligations. You can still owe filings even if you owe little tax. But yes, the deduction matters. If you're a single filer earning $40,000, a $15,900 deduction reduces taxable income significantly. That's real relief. And for seniors, there's an additional standard deduction layered on top, commonly described in this context as $2,000 additional for single or head of household filers age 65 plus, and $1,500 per qualifying spouse for married joint filers. That means if both spouses are over 65, the deduction can rise even more. Why does the government give seniors an additional deduction? It's not generosity, it's arithmetic. Seniors often face higher medical costs and many live on fixed income. The additional deduction is one of the few blunt tools the tax code uses to approximate that reality without requiring everyone to itemize medical expenses. But here's what you need to understand. A bigger standard deduction can reduce your taxable income while still leaving you exposed to Social Security taxation thresholds and required minimum distribution rules. It's not a full shield. Now let's talk about tax brackets, because if you're a senior taking distributions or an immigrant with multiple income streams, brackets are where you either keep your money or surrender it. The U.S. tax system is progressive. Higher slices of income get taxed at higher rates, with brackets ranging from the lowest to the highest. Brackets are adjusted for inflation to prevent bracket creep, where inflation pushes you into higher rates even though your real purchasing power didn't improve. That's the theory. In practice, you can still get bracket creep through your own decisions. One large IRA withdrawal, one Roth conversion done at the wrong time, one sale of property, one chunk of foreign pension income recognized in a single year. And for seniors, it gets even darker because certain tax cliffs don't adjust with inflation at all. That's not a mistake. It's a quiet revenue machine. Here comes the second open loop. The most overlooked tax cliff for seniors is Social Security taxation thresholds, and those thresholds have been frozen for decades. So even as brackets adjust upward, Social Security becomes taxable for more and more seniors over time. That's not your fault. It's structural. Let's go there now, because this is where retirees get hit with surprise bills and then blame themselves. Many people think Social Security is tax-free. It can be partially tax-free, but it depends on what the IRS calls your combined income. Combined income generally includes your adjusted gross income, plus any tax-exempt interest, plus half of your Social Security benefits. If combined income exceeds certain thresholds, a portion of Social Security becomes taxable. The common thresholds discussed for single filers are $25,000 and $34,000, and for married filing jointly $32,000 and $44,000. Thresholds that are widely known precisely because they haven't moved much in a very long time. Once you cross the first line, up to 50% of benefits may be taxable. Once you cross the second, up to 85% may be taxable. That doesn't mean you're taxed at 85% on everything. It means up to 85% of your benefit can be included in taxable income, depending on your combined income calculation. But the emotional impact is the same. Seniors receive a surprise because they were told Social Security is earned, and they assumed that means untouchable. Now, why is this particularly dangerous in 2026? Because of verification and automation. The IRS already receives Social Security benefit reporting. It receives 1099-Rs for retirement distributions. It receives brokerage statements. And as the agency modernizes and matches information more quickly, errors become easier to detect, and underpayment becomes easier to penalize. You don't get years of quiet non-detection the way people did decades ago. So what do you do if you suspect your Social Security will be taxable? You don't wait until April. You control withholding or estimated payments. You can request federal tax withholding directly from Social Security using Form W-4V, choosing a withholding rate like 7%, 10%, 12%, or 22%. Or you can make quarterly estimated payments. The goal is not to guess, it's to avoid an ugly surprise plus underpayment penalties. Now we pivot to the subject that can generate the most punitive penalties of all for seniors, required minimum distributions, or RMDs. Under rules popularized through the Secure Act and Secure 2.0 framework, the age for RMDs has increased, often discussed now as 73 for many people, depending on birth year. The concept is simple. Traditional retirement accounts like traditional IRAs and many 401ks were funded with tax-deferred money. The government eventually wants its tax. RMDs are the extraction mechanism. Once you hit RMD age, you must withdraw a minimum amount each year based on IRS life expectancy tables and your account balance. If you fail to take the distribution or take less than required, the penalty can be severe. In the framing you're working from, that penalty is described as 50% of the amount you should have withdrawn, but didn't. That's not a slap on the wrist. That's confiscatory. Imagine you were supposed to take $20,000 and you took nothing because you didn't realize your account changed custodians or because you assumed your financial advisor handled it. A 50% penalty would mean $10,000 plus the taxes you still owe on the eventual distribution. That is how retirees lose chunks of retirement savings to pure compliance error. And here's what makes 2026 more dangerous: improved tracking. Financial institutions report distributions. The IRS matches forms. Automated systems identify missing RMD patterns. The slip through the cracks era is ending. The machinery is getting better at catching you. Now, I'm going to open a third loop because this is the part that will save certain retirees thousands. The first RMD timing trap. In some cases, your first RMD can be delayed until April 1st of the following year, but then you may have to take 2 distributions in 1 year, your first and your second, potentially pushing you into a higher bracket and increasing Social Security taxation. Many people think delaying is always good. It's not always good. Timing is tax warfare, and you need to choose the battlefield. Now, seniors aren't the only people exposed in 2026. Immigrants are walking into a different kind of trap, one that punishes you not for how much you earn, but for where your money sits. If you hold a green card, you are generally a U.S. tax resident and subject to worldwide income reporting. If you meet the substantial presence test, you can also become a tax resident even without a green card. That means the IRS expects you to report income from everywhere, not just the U.S. Wages, business income, rent from a property back home, foreign pensions, interest, dividends. And even if a tax treaty reduces double taxation, reporting obligations remain. But beyond income, the U.S. has a special obsession: foreign accounts. This is where FBAR comes in, the Foreign Bank Account Report, filed on FinCEN Form 114. If the combined value of your foreign financial accounts exceeds $10,000 at any time during the year, even one day, you have a reporting requirement, not per account, combined, and it includes not just accounts you own, but often accounts where you have signature authority. That signature authority detail is where honest immigrants get destroyed. You're helping your parents. You're a signer on a family account. You don't consider it your money. The government may still consider it reportable, and if you don't report, penalties can trigger. Non-willful penalties are often described as up to $10,000 per violation. Willful penalties can be catastrophic, often framed as up to 50% of the account balance, depending on circumstances and enforcement posture. This is why people should stop treating FBAR like an optional form. It is not an optional form. Now, the source you provided also points to the larger trend in 2026: enhanced IRS technology and international information sharing. This is not conspiracy. FATCA, the Foreign Account Tax Compliance Act, has already forced many foreign financial institutions to report U.S. account holders. Global transparency has increased. Banks that used to ignore U.S. compliance are now terrified of U.S. penalties. That means the IRS's visibility is expanding, not shrinking. And this is where the immigrant trap becomes a liquidity trap in your life. You think you can keep a small account back home just in case, but the system interprets that as a reportable asset requiring precise compliance. If you don't comply, the government can levy penalties that dwarf the value of the account itself. That's not a fair proportional system. That's a deterrence system. Now, here comes the devastating mistake I warned you about earlier. Once people realize they missed FBAR or foreign asset reporting in prior years, they panic and do a quiet fix. They file late forms without guidance, hoping the government won't notice. That approach can be dangerous depending on your facts, because you might be admitting non-compliance in a way that gives the IRS a timeline without giving yourself the protections of structured compliance programs. The safer reality is this: the IRS has pathways for coming into compliance when failure was non-willful, including streamlined filing compliance procedures and other delinquent submission procedures in certain circumstances. But eligibility depends on facts. Your intent matters, your timeline matters, and your documentation matters. This is where you stop DIYing and talk to an international tax professional if you have any meaningful foreign footprint. Now let's talk about enforcement, because 2026 is not just about new numbers, it's about a changed posture. The IRS has received increased funding in recent years to improve technology and compliance. That usually means more matching, more notices, and more audit activity in categories the agency believes produce revenue: high-income filers, complex international transactions, questionable credits, and retirees with large retirement accounts making inconsistent withdrawals. If you're a senior, your risk isn't that you're a criminal. Your risk is that you miss a distribution, misclassify a rollover, under-withhold, or trigger Social Security taxation unexpectedly. If you're an immigrant, your risk isn't that you're hiding money. Your risk is that you don't understand U.S. worldwide reporting and foreign account disclosure rules, and you assume the IRS won't find out. That assumption is dying. Now, I'm going to give you a tight, practical playbook. What you actually do in February, in summer, and before filing, so you're not reacting in April with panic. First, know your filing status and standard deduction. Most people should not itemize unless they clearly benefit. But don't assume. Let a professional run the comparison if your medical expenses, mortgage interest, or charitable contributions are large. Second, seniors. Map your income sources for the year: Social Security, pension, IRA, 401k, distributions, investment income. Estimate combined income. If Social Security will be taxable, set withholding early. Don't treat April as the first time you think about taxes. Third, if you're approaching or past RMD age, set up an automated RMD plan with your custodian and confirm it actually executes. Do not assume. Verify. One missed RMD can cost more than a year of careful budgeting. Fourth, immigrants and globally connected families. Build an inventory of foreign accounts and assets. Track maximum balances. Identify whether you hit the $10,000 FBAR threshold at any time. Determine whether Form 8938 might also apply depending on your status and asset values. Report foreign income even if you paid tax abroad. Then use credits or treaty benefits where properly applicable. Fifth, if you discover past mistakes, don't hide and don't improvise. Document what you missed, gather records, and consult a professional who understands FBAR, FATCA, and compliance procedures. The cost of proper correction is usually far lower than the cost of penalties. Now, one more dimension that seniors especially underestimate: state taxes. Federal tax is only half the story. States vary wildly. Some have no state income tax. Some tax Social Security. Some tax pensions differently. If you're retired or about to retire, where you live can change your net retirement income by thousands per year. People relocate for weather and family. The tax system relocates them for survival. I'm not telling you to move. I'm telling you to stop pretending geography doesn't matter. Because if you're living on fixed income, a 5% to 10% state tax difference can be the difference between stability and anxiety. Now, I'm going to be honest about the one thing nobody wants to hear. If your finances are complex, professional help is not a luxury. It's risk management. A competent CPA, enrolled agent, or tax attorney doesn't just fill forms. They plan timing, distributions, withholdings, credits, treaty positions, and compliance filings. They prevent the kinds of mistakes that become expensive. Not all preparers are equal. International tax is specialized. Retirement distribution planning is specialized. You ask directly, do you handle FBAR? Do you handle Form 8938? Do you know RMD rules? Have you helped clients with compliance corrections? If the answers are vague, that's your warning sign. And because this is Immigration News Desk, I'm going to connect this back to the immigration consequences people ignore. Tax compliance can affect your life beyond money. It can complicate naturalization. It can raise credibility questions. It can create evidence problems when you need to prove residence, employment, and lawful behavior. In a stricter government posture, being generally compliant is no longer enough. You need to be documentably compliant. So here's the final takeaway. 2026 isn't just a year of tax changes. It's a year where the compliance machine is getting sharper. Standard deductions may rise and help many households, but the traps remain. Social Security taxation thresholds frozen in time, RMD penalties waiting for one missed step, foreign account reporting rules that punish ignorance, and automated matching systems that catch discrepancies faster. If you want to protect your money, you do not wait for a notice. You don't wait for a friend to get audited. You don't wait until the last weekend before filing. You build your compliance system now. If this helped you, share it with one senior and one immigrant family in your circle, because these are exactly the groups that get blindsided. And subscribe to Immigration News Desk, because we don't just cover immigration forms, we cover the hidden compliance pressures that can destabilize your status, your finances, and your future in the United States. You worked too hard to lose thousands to a paperwork trap. In 2026, being informed isn't optional, it's a form of self-defense.